Eric, we're back. It's great to see you again. I never know how to start these episodes because it feels like every time we get together, it's like, what a crazy week in AI. And yet it's always true. That's just the nature of the space right now. I don't know what you're seeing out there, but I had a couple headlines come across my radar just trying to prep this morning that I had forgotten. And it was only, a week and a half ago, some crazy stuff that happened.
Yeah, it's what makes this podcast exciting. I don't think it's going to be slowing down anytime soon. So, just buckle up. We'll have to get used to it, right?
Yeah, the stories are compounding faster than these models. I just wanted to sync real quick for our listeners just to put some of this into perspective. These are just some of the things that have happened in the last 2 weeks. So NVIDIA and AMD shook a hand with the Trump administration. They're going to pay 15% tariffs, more or less, on their H20s and their 308 chips that they are now allowed to sell to China. So a big development there. Intel, perpetual chip whipping boy in the tech industry, has been on a total whipsaw. Lip Bhutan hasn't even been there a year. And Trump, he catches a stray from Trump, says he needs to step down. 72 hours, gets like the rarest thing, the blue lobster, which is a compliment from Trump. And now there's news that the federal government might take a position in Intel. What a crazy whipsaw 10 days that was. You've got portfolio company Coherent releasing earnings, beat on the top line, weak earnings, down 20%. I think we might talk about some earnings a little bit here. CoreWeave, second hottest IPO after Figma, exact same story, beat on the top line, down 20%. A little credit your way. I think it was about 3 or 4 episodes ago. Our listeners might want to go back and check. You had warned about this. You said, hey, valuations are getting a little stretched. There's a little enthusiasm out there. We should expect volatility to increase. And I think the Coherent and CoreWeave earnings are 2 great examples of that. So credit to you for putting people on notice there. We have a completely left field acquisition proposal from Perplexity to acquire Chrome, which won't happen, but I totally respect the gumption of it. I mean, they're going to shoot their shot. They feel like, Alphabet is in an antitrust corner now. So, hey, you miss 100% of the shots you don't take. And then the big one, which I think we're going to talk about, which is the GPT-5 release. And what struck me about this, I know I'll get your thoughts later, but the model smashing math benchmarks and expectations, but the consumer review feedback's kind of maybe a little shrug. And it reminded me a lot of the Grok 4 model release, where it's smashing all the benchmarks, but consumers kind of, didn't really feel it was that different in a day-to-day usage level. So that's just some of the news in the last 2 weeks. We got to keep our head on a swivel. There's even more that we're going to talk about, but I just wanted to talk about some of the stuff that came across our radar because, boy, it's hard to keep track of it all.
Yeah, it's a good summary. We could definitely talk for 2 to 3 hours if we wanted to. We will spare people that endurance test. But like you said, we had warned that there would likely be some volatility. We saw a really furious rally coming out of April and into the summer. The market was really overdue for a break. We're seeing some signs of that right now. You've got inflation fears ramping, a lot of signs of consumer weakness happening right now. We see some proprietary data in kind of interest in stocks from some of the areas that we have visibility into. You also see consumer sentiment shaky. Mm-hmm. So, Austin, as I look at our portfolio, you mentioned earnings. We saw a couple poor earnings. Coherent's one. We've seen the portfolio go down from some peaks that I had earlier this week, around 40% returns on average from recommendation points. It's at about 33% right now. We've seen momentum stocks kind of stalling out a little bit. So, this kind of consolidation period, it's to be expected after you've seen a rally of this size. But the overall trajectory of news, I would say, continues to be positive.
Yeah, I would reiterate that overall trajectory positive, but softening a little bit. There was a piece in the New York Times, I think it was in the last day or two, that was something to the effect of, hey, markets are getting real scary right now. And I'm seeing a little bit more of that tone where people are maybe fully invested, but they're a little just concerned with how far things have gone. And let's be clear, that doesn't mean that there's any fundamental problems, but it is a good time to maybe pause and say, hey, how many of these positions have run on narrative and how many of these positions have run on fundamentals. And there's always going to be a wheat from the chaff moment. Some of these stocks could still be cheap based on what their business fundamentals are. Some of them could have narrative running beyond them. So, hey, that's what we're here to do, though, is to help separate, the stretched multiples from the reasonable ones. So, Eric, I allude a little bit to the GPT-5 release came out. My impression was consumers were a little disappointed, but the benchmarks were good. I read something a little different in sort of this data center measuring contest that Elon and Sam Altman got into, where they were using each other's models against each other. It was hilarious. It was funny. But what I actually was reading in that little tiff they had comparing their newest models were that they were talking about data centers, or implying data centers based on chip usage that are in the 5 to 10 gigawatt range. So past the mudslinging, I'm actually still seeing a lot of positive sort of cash tsunami coming out of the GPT-5 moment, even if consumers aren't that positive on it. But I really would like to hear your feedback. And what did you see in the GPT-5 release?
Yeah, so let's just start downsides to this release. First of all, I should say, why is GPT-5 a big deal? Because it's been teased for a long time. OpenAI, they released a kind of intermediate model in GPT 4.5. They finally gone to GPT-5. So there's just a lot of hype and enthusiasm around this. And when you have a lot of hype and enthusiasm, you're bound to disappoint people, right? You can't live up to something that's been building this long. So one of the
self-driving Teslas are right around the corner.
Indeed. So what we're looking at is the longer that these models are the longer we have of a track record of these models, the more that personality is fundamentally built into them. And 4.0 is kind of famous, infamous, whatever word you want to use, for almost being sycophantic, where it is very laudatory towards users. They toned that down quite a bit on GPT-5. So people who had gotten used to the responses, a lot of people are now beginning to prompt AI hundreds of times a day. So it becomes almost, it's more than a coworker. It's something that's a right-hand person. And if it all of a sudden changes personalities, that can be very jarring to people. So we're seeing a lot of kind of the consumer blowback from that angle. Now, Austin, the pros for GPT-5, one area that we've talked a lot about on this show is the massive progress that's been made from reasoning models, but you haven't seen as much consumer adoption on. Number one, it's not the default action that people have to take. Number two, they take longer for responses. What GPT or ChatGPT-5, I should say, has is a new thing called a router, which when you're typing in your queries into ChatGPT, it's going to be able to route you to the correct model. This is a really big deal for a couple of reasons. Number one, it's going to increase reasoning usage exponentially. Sam Altman already said that use of the reasoning models is up 7-fold from where it was before they had released this model. Second, it's going to give OpenAI itself a much better approach to the economics. One thing that ChatGPT, or GPT-5, I should say, does behind the hood is it's a lot more efficient. It's going to have better unit economics. So that's a big deal for OpenAI itself. Now, one more thing I'll mention. You talked about this data center often.
Yeah,
we have been watching it. It's pretty entertaining. I don't know if I ever expected a future that this was how kind of CEOs talk to each other, but hey, here we are. Number one, Sam Altman, who's the CEO of OpenAI, he emphasized that the company had to double its number of GPUs. They are going to double, I should say, looking forward across the next 5 months. Second, when we look backwards, the company had to get 200K GPUs online the last 60 days. And overall, they have 15x'd their compute since 2024. And the main point here, Austin, we've talked a lot on this show about how one of the biggest trends, especially as we enter the back half of 2025, is NVIDIA shifting from a prior generation of GPUs called Hopper to a current generation named Blackwell. We are seeing the last generation of models come out now that were predominantly trained on Hopper. Going forward, we're going to get a big shift in GPU capability towards these Blackwell clusters of chips. So that is something important to remember, is that while we're looking at a model like this, it still doesn't have this compute tsunami that's happening in the background. So I think that's really important for investors to understand, especially when they're trying to think, why is so much growth forecast still ahead?
Right. And when you talk about that, we also need to realize the scale of these data centers, the challenges of training, the amount of time it takes to train. When Blackwell chips are sold, it doesn't necessarily mean that they are training the next day, right? You still have to build these centers. You have to do all the interconnects, then you have to do the training runs. So this might be very well like a lull, right? Like the last of the Hopper generation. And then what would you say? Maybe 12 months, 18 months, we should start seeing some Blackwell trained models and we should start seeing some of the performance gains from Blackwell. Is that too long? Like what sort of a time scale should we be thinking about for when those Blackwell trained clusters will start to show themselves?
Yeah, we just saw a transition period this past quarter where Blackwell is beginning to exceed Hopper. So yeah, it's going to be in the next 6 to 12 months is when these massive clusters, and again, you need to build these massive data centers as well. You see something like Meta going forward to build their 1 gigawatt data center. I would assume that's going to be almost entirely Blackwell chips and maybe some combination of some of their custom chips as well. But this is almost everything in the forward-looking time frame. Yeah, across the next 6 to 12 months, I would say.
Okay. Well, hey, let's move on a little bit. One of the ways that most people, I think, if you're in 2025, people have largely interacted with AI in one of two ways. Most consumers have interacted with it through the chat interface, or if you're a developer, through coding, and incredible potency there. We've seen a lot of that's most of the use cases, but video has gotten a lot better. And I remember when Dolly came out, and there were all these kind of like fun tests, or like the Will Smith spaghetti test was considered the benchmark, and now it's been smashed. But it's moving into more multimedia. I think it conquered audio pretty quickly, but video is a little bit of a challenge. And we're now seeing some other interesting AI news out of Google, specifically Genie 3, right? So talk to me a little bit about that.
Yeah, so Google, there's so much activity every single week. You cover something like a GPT-5. There's other releases happening in the background, and it's often multimodal in areas that aren't just, text. So we've got Genie 3. It's from Google. It's creating interactive worlds. So it's not just video that you can see like we've seen with things like Sora in the past. These are real worlds that you can navigate. And also they include promptable events. So you could change weather, you could add characters. It's pretty cool, Austin. Now the limits on this for now, it's still, we're talking a few minutes rather than hours, but
and hey, who has that kind of time today, Eric? Who can really, what is this, the DMV?
Well, this is what we're talking about, that OpenAI, they've seen 15x increases in compute. That's from buying more compute, and it's from the compute they're buying getting better. So if Google has across the next year massive purchases of things like Blackwell chips, they're going to be far more efficient. They're going to be far more powerful, and they're going to also be buying more of them, that rising CapEx number. So, this is something, to your Will Smith example, we could look at him eating spaghetti and it looking cartoonish and becoming a meme a year later, looking pretty good. In a year, what we could see is the ability to push these worlds out to much further periods. And again, the longer and longer we go, this gets more and more economic. So Austin, I think two key points here. Number one, what this does for the video game industry is potentially fascinating. The ability to create worlds on demand that you can interact with. I've actually reached out this week in part because of this Genie story to a video game expert that we're going to have in an upcoming episode, because I think what we're looking at in terms of industries that are going to see massive disruptions from AI, video games has to continue moving further and further up the list. Second, on this topic, I think you do see something like this, and it probably helps you understand Mark Zuckerberg's bet a little bit more. He has this idea of a metaverse. He has a cartoonish looking picture of him, and everyone laughs at it. And you go forward 4 or 5 years, and we're at a place that you can build these kind of real worlds on demand. And you think about what that could do for people engaging in digital spaces, and it is a little mind-bending. So I think Genie 3 right now is just a few minutes, but this idea to create worlds you can interact with are promptable, last a few minutes, and going towards being persistent within the next 5 to 10 years. There's something deeply powerful here we're seeing a preview of today.
Choose Your Own Adventure video games it sounds a lot of fun, like a lot of fun. And why are video games so interesting? one of the things a lot of people don't realize, because everybody touches music, everybody touches video, most people don't realize how much larger the video game industry is than those other industries. So, and of course, as you solve problems and create value in bigger industries, there's more money that can then feed into, the profitability of these models and the investments you're making in data centers, right? So that flywheel starts spinning. Let's put some real numbers to it. The music industry is a $30 billion industry. The movie industry is a $100 billion annual industry, so 3 times as large. Video games are 300 billion, right? So 3 times as large as video. So if you can start solving that video form factor, like we've talked about, like AI for Netflix or AI for HBO, Disney, everybody sees that coming. That's $100 billion. But if you then take it a step further and you get interactive, it's now 300 billion. So you layer this whole 3 times larger industry on top. And that's so you got to look past maybe just the video aspect here to what this really could do for that space. And fantastic. And look, who would not want to play even more immersive, interactive Zelda, Tears of the Kingdom, Breath of the Wild? What an amazing video game that would be if you could layer on some of these more AI-powered elements to it. But hey, enough of that. We're going to have a lot of video games, I'm sure. I'm excited to try some of the new AI-powered worlds here. Let's move on to earnings. Earnings continue. We talked about earnings season in a prior episode. There have been a couple other earnings since then. We talked about CoreWeave and Coherent at the open, but I wanted to look at some of the portfolio positions. So Micron, let's start there. They raised their outlook for the current quarter. What else did you see? And there's a very important talk to me a little bit about why, maybe remind our listeners why Micron is in the portfolio and what role they play in the AI tech stack.
Yeah, I know we've got a lot of new listeners, and not everyone's going to remember a podcast they listened to 7 months ago. I won't hold that against anyone, so it's important to review what's going on here. Number one, the news is Micron, they raised their outlook for the current quarter, $11.2 billion in revenue versus expectations of $10.75. It's going to translate to a big beat on the EPS side of $2.85 and profits versus estimates of $2.52. So, Austin, the key point here is that memory is very important for AI. And newer systems, whether it's custom chips from Broadcom or these NVIDIA Blackwell systems we've been talking about across this podcast, they require drastically, I should say, more memory. So the AI market for memory chips, which is a space called high bandwidth memory, it's expected to grow 96% this year, 55% this year, and SK Hynix, which is one of the memory companies, they're predicting a CAGR of 30% through the end of the decade. So this is a trend that is very persistent. Now, at the beginning of the year, we predicted that memory would be a key theme across the year. I think that is playing out on a high level as we're seeing with some of those projections. We had recommended SK Hynix. Unfortunately, it's a very difficult stock to buy because it's in Korea. We've had viewers reach out that they did buy it. You can purchase it in Germany, for example. It's up 30% since then. We had recommended Micron, far easier to purchase, a little more expensive than SK Hynix. That one's up about 20%. We saw it just had those great pre-announcement of earnings. And Camtek, which is a little bit more on the speculative side, what it has is advanced tools for detecting defects when you're creating AI memory in a space called metrology. That one's down about 16% since we recommended it. That's largely due to the relatively brutal space it's been operating in. But, the key point here, Austin, we talked about memory as a key theme at the beginning of the year. What Micron's earnings do is validate this concept that we have. And if anyone out there hasn't purchased any stocks in the space, we just went through and reviewed them. Camtek, again, it's in a very brutal industry in semiconductor equipment. We'll get back to that a little bit later, but could be one that you could still add to your portfolio. Just, kind of position it correctly. I think we've got a 2 or 3% position, so you'd want to keep it pretty low.
And look, if you're struggling on that SK Hynix buy, and we do empathize with that, sometimes it can be a challenge to buy things on different exchanges. The Micron ticker is MU and the Camtek ticker is CAMT, I believe. Am I correct on that?
You're correct.
All right. So, Eric, we talked about some sell-offs. We saw a few, maybe expectations running past reality just a little bit. You had labeled this a little bit like the DeepSeek moment for software, specifically SaaS. And a lot of people have alluded that this would happen for a while. Now we're actually maybe starting to see it. Like companies like Salesforce and Mondays were like squarely in the eye of the storm here. So what are you seeing? And the argument here is that as AI becomes so powerful and as AI becomes, we sort of hit super intelligence, you can build bespoke software exactly for your needs. And you don't need to enter into these per seat SaaS contracts, which are both very expensive and can be really long run. And then as these SaaS contracts get deeper integrated into your organization and you hire more people, you just have to add more seats and you just sort of get locked into this ecosystem. Hey, that's why SaaS was the best business model on earth until AI, right? So it worked really well for these companies, but now here comes an existential threat. So what is going on and what are some of the companies in this space that stand to get hit by this?
Yeah, DeepSeek was so fun in January. I was like, can we just do it again? And here we are. So yeah, it's a great point that circa 2021 SaaS, all that anyone talked about was it maybe being the greatest business model ever. And 5 years later, people are trying to jump off the ship and calling it something that's busted. It shows how hard investing is, how dynamic it is. But yeah, so we're seeing a bit of a DeepSeek moment. A few examples of this. Monday, software stock with a lot of agentic ambitions. It issued a large beat last quarter, guided up, but the guidance was a little slightly like $1 million below expectations. It fell 30% that day. We talked about ServiceNow last podcast. They issued strong earnings. They were up 8% after hours, heading into the next day. They are now below that level, and they're now down 20% year to date. And Salesforce, kind of the 800-pound gorilla in the SaaS market. They used to see gains from targeting, from kind of talking about trajectory from their Agentforce platform. No more. The market is not buying it. The stock is down 30% year to date. So, Austin, we did get a listener question this week, which was, does agentic AI within the next couple of years make Synopsys, Cadence Design, and GitLab, all recommendations in the portfolio, irrelevant? So let's take a minute to kind of deconstruct this. I think one thing you need to nail, I've talked about getting into the right stocks before this agentic takeoff, because what you'll often see is companies will begin seeing this revenue acceleration. And as they're starting to see revenue go from 24 to 25 to 26 to 27, you're going to have the market begin often re-rating them. But what you need, if you're going to re-rate, the number one most powerful force in the short term for any stock isn't what its actual results trajectory is. It's how the market is changing its narrative around the company, what it's willing to pay for sales into the near future and earnings into the near future.
And so, Eric, the best company that you've talked about that illustrates this, sorry to interrupt, but it's a really good point, so I want to land on it, is Palantir, right? This is a company that didn't see their earnings 5x, but they saw a re-rating of their multiple because they were able to get a much better narrative and they were able to get investors to price that future cash flow. Now, let's be clear, they did score some big contracts, but their stock has run well in excess of their revenue growth because of the narrative change.
Yeah, and it's because they're thought of as essential to the future of software, and the other stocks are being priced as if they're going to be roadkill. So if we look at the stocks that we've picked, I would say we're some combination of lucky and kind of having the right strategy. If you look at our software plays, Synopsys, as was asked about in that question, is up 26% since we recommend it. Cadence is up 14% so far. They haven't really been targeted in this narrative roadkill, in part because they're more associated with semiconductor engineering. Obviously, designing semiconductors, it takes a lot more trust than just grabbing a vibe-coded tool. So you might not have it. It's a lot more risky to pull out Synopsys than a CRM tool. I'll say that much. Cloudflare, they've been broadly seen as a beneficiary from these trends, much in the same way that Palantir has. Snowflake, we targeted as an enabling technology. So they have seen some sell-off just because you're seeing a lot of money move out of software, but they are up 24% year to date. We bought Unity, which is up 50% year to date, while other ad tech stocks like the Trade Desk have absolutely crashed recently. And GitLabs are one kind of stock we're caught in the crossfire of this kind of battle that's happening. That's down 40%. So 5 of the 6 stocks in this bucket we've bought have done well. Well, the broader market crashes. Austin, I did see you were looking to say something. Did you have a point here?
Well, no, I was just going to say, I love this question, but Synopsys is really in such a specialized industry, right? Electronic design automation and EDA is so specific to designing chips. I mean, you're very much I don't want to exaggerate here, but like you're at the edge of physics, right? You're dealing with impossibly small and impossibly complex structures, and they need to operate perfectly exactly. And there's sort of no room for hallucination or the probabilistic results that AI is currently generating. Now, maybe an AI has always struggled with exact math and perfect math and clean math. So Synopsys feels the most protected to me, but I actually just wanted to maybe expand, your DeepSeek moment and mention a couple other companies that have really valuable products that are now really easy to replace in a couple of weeks with a talented developer vibe coding. Atlassian down 30%, Workday down 13%, Adobe down 20%. These are all year to date. Yeah. Adobe has impressive products, but Figma, maybe that what we're seeing year to date for Adobe is just because now Figma's out there as an alternative. But Atlassian does it for me. I mean, fantastic products that were kind of easy, no-brainer investments for any corporation, now down 30%, because when you look at the complexity of what they are, maybe you can just recreate that internally with one talented developer and have a product that's really specific to your corporate needs instead of general purpose.
Yeah, and a lot of these stocks, they are also just extremely expensive, and you're seeing some air come out of there. One of the reasons we had purchased GitLab initially was because it was on the cheaper end of SaaS, and we saw some potential for this happening. But I think what this does require, it requires a little bit of a different investing framework. We've talked a lot about software stocks needing some combination of complexity, data, and distribution. You look at the gray stories in software, Meta, you could call it tangential. That's a company collecting unique data, unique distribution points towards consumers via their apps. You look at Microsoft. I mean, they've got distribution pathways. So as all of these trends happening, they're able to go out through their sales force and become more embedded, and they've grown that. So I think for like a GitLab, I took down a quote that I saw on Twitter. I don't know who this is, Austin. Maybe you could find this exact quote so I can credit them. But they said GitLab provides the hosting and history of code, testing of code, running the code, securing the code, deploying the code. It has a scaled GTM team, distribution, and enterprise trust. If you want to build a perfect AI coding agent, you need all these pieces. And I think that is clearly the market disagrees with us to date. But I do think that GitLab is a company with suitable complexity, working in environments where you need extreme trust and an ability to scale revenue acceleration thanks to agentic AI. So, there's a very vigorous bull-bear debate around this specific company. I haven't lost faith in that to date, but what it does make me do is it does make me go and reevaluate some of the companies I had been considering for the portfolio. So I was pretty close to pulling the trigger on some agentic plays. I did kind of pull that back in because I wanted to make sure I was evaluating market sentiment properly. So we'll see if we've got some in the current weeks. But I think in the long run, much like the original DeepSeek, a lot of this sell-off is going to be kind of exaggerated. And part of it's just because some air did need to come out of a lot of these stocks, which we kind of saw a similar situation with DeepSeek as well, that there was extreme enthusiasm head in and it created an environment that was ripe for an overreaction.
Right. I love that. Eric, can we move on a little bit? I have a listener question I wanted to get to. And hey, if anybody has any feedback on our most recent episode, we did a little AMA listener question episode a couple days ago. I'd love some feedback on that. If people enjoyed that, please leave us a comment. We can do more. If you didn't, just ignore it. And we'll keep on our regularly scheduled program here. But Eric, we have a listener question, and this is about the machines that make the chips. And I love this. I could watch an automated factory all day long. I think it's the best entertainment. I didn't mention to you, but I got to tour an electric aircraft factory last week, which was really cool, and see some of their custom machines making custom parts of this plane. And it's just watching robots make other things is just so cool and so fascinating. So I love this question. Let's get into this. It says, hi, Eric, Austin, and the 24/7 Wall Street team. Great episode. For those that are looking for more international exposure, what about Tokyo Electron at this time? I'm about to listen to the most recent Q&A, so apologies if this has already been discussed. You've talked about Tokyo Electron a few times, but let's answer it. Tell me about this company. What is the backstory here? What do they do?
Yeah, we're all nerds here, so we can agree on this. Extreme engineering is
space
cool.
for nerds.
It's great. So yeah, the background, I try and the industry is called semiconductor equipment, but I realize I use those words and I lose half the audience immediately. So we're going to call them the machines that make the chips. There's a big five in this space of companies that dominate most of the revenue, control most of the value chain. That's ASML, which we've talked a lot about. Tokyo Electron, which we've mentioned, but probably talked a little less about. Lam Research, which we own. Applied Materials, which has probably the biggest breadth across the industry, and KLA Tencor, which has kind of a dominant position in that market we talked about earlier of detecting defects in chips. So these stocks all saw excellent returns in the 2010s. A big reason behind that, we saw less severity in semiconductor cycles. It's a brutal industry that got shaken out and consolidated. And eventually, most of the parts of the value chain have only 2 or 3 primary companies competing. And, if you're one of the companies that builds the chips like a Taiwan Semiconductor or Intel, your relationships matter. And working with a smaller company introduces a lot of risk. So, that's one of the interesting things. A lot of people say, I don't want to invest in semiconductors because it's brutally competitive. There's a lot of memories back from the 1980s and 90s. The reality of the situation is it was that way, but because it was so brutally competitive, almost every part shook down to an oligopoly or just a few companies, and they were birthed in the flames, right? They had to come through this battle and survive to become generally lean and extremely competitive companies that are hard to be a startup and compete against. So we love the industry for that reason. It should be one of the biggest winners from AI. And yet we don't have many recommendations in this market, despite the fact that it did so good in the past. In Austin, we've talked about the reasons why. But number one, customer concentration. We have very few of the leading fabrication companies that make chips because it's gotten so expensive, and very few companies have the expertise. And once again, one company is just so good at, and that's Taiwan Semiconductor. They've essentially run out of their competition out of town. The second part is that the number one way to engage in a trade war, if you're focusing on technology, is start at the beginning. Make sure that your competitor, which is China, doesn't have access to the ability to make chips. So these companies become essentially your negotiating tactic. This introduces 2 problems. In the short term, sales turning on and off to China is going to create a lot of volatility. And in the long term, China has every incentive in the world to make their own domestic suppliers who will go out and compete on cheaper price and kind of ruin this oligopoly situation. All right, so that's a very long background setting up what this industry is. But what we saw recently in earnings, this was on Thursday, August 14th, was Applied Materials reported, and they issued very bad guidance. Their sales are declining year over year, and they cited 2 reasons for it. And it's exactly what we've been talking about since the beginning of this podcast. Number one, they are experiencing some pressures on their leading edge, their most advanced equipment. And that's because Taiwan Semiconductor has so much concentration, they can push these companies around more. And second, they're seeing volatility around Chinese orders. So this is also going to hurt Tokyo Electron, who this question was about. They had a pretty poor guidance themselves leading into 2016 earlier this season. And this is the reason we've cut our exposure in this market down to just 2 companies. And that's Lam Research, which it's down today, and that's purely because of Applied Materials. It's not something the company did, but they are the top performer in this market this year, along with KLA Tencor. And for KLA, we don't have them, but we have a smaller upstart in Camtek. So I would say, well, our returns haven't been great in the space. Lam Research has done fine. It's the best of the group. And Camtek, as we mentioned earlier, is down 16%. We have positioned ourselves as well as we could And frankly, we could have gone a lot deeper in this market, and we've been lucky to avoid it. So I think, am I going to be adding Tokyo Electron? The answer is no. For all the reasons I've stated above, we will look to other opportunities.
I'm not sure if this is the right analogy, but just hearing you talked about these baptism by fire industries where there's many competitors and it distills down to 3 or 4, and it sort of becomes a little bit of an oligopoly there. It reminds me of railroads, auto manufacturing, television stations. We saw the same dynamic where you have lots of different companies trying to enter these spaces that are very capital intensive, very technically complex, and then they end up collapsing down to the few really competent winners. I don't know if that's the right analogy, but it feels similar. Now, this industry also has the interesting dynamic of being a political chess pawn right now, where their future is outside of their own control. So they're all very impressive, sophisticated companies, but as we've talked about with ASML at length, they don't control their own destiny at the moment.
Yeah, and it's really hard to get involved with. There's one famous story where they were building a fabrication facility, but it was too close to a farm. So the cow farts were introducing methane.
That's right.
So, yeah, they had to go and buy the farms to get rid of the cow farts because it was ruining the chips. And it's just, you don't know unless you do. People think this is all solved in spreadsheets. There's a lot of kind of alchemy happening here where it's just trial and error. And, I can't find a way to describe that alchemy better than cow farts.
I love it. So you and I shared a video earlier about robotics. I want to talk a little bit about that. My favorite topic. There's also, I need to find a thread. Maybe I can put it in the show notes that you and I had shared about the advancements in actuators and what that will do for sort of the progression of really smooth humanoid robots. It was a really interesting video. I think it's like a Da Vinci actuator. It was on Twitter. So if anybody can find that, it's a great video. But you had shared a great video about robots folding laundry, which is a topic we have literally talked about many times. I don't like folding my laundry. I don't like putting away my groceries. I want it to happen. But I want, we take for granted, although these are basic processes, there's a lot of subtlety to them, right? You have to have really good, fine motor control and actuators and all that. So tell me what's going on in this video and what can we glean about it in this industry as we're trying to make investments?
Yeah, this was just one of the cooler videos we've seen across the past week. It's from Figure AI, which is probably one of the most interesting private companies right now. The demand for their shares in private markets is through the roof. The key concept here is this video of a robot folding laundry, which hopefully we can embed in our YouTube channel. Just another reason, superior to watch this on YouTube, is that this is all done through neural nets. That is to say, there's no adjustments to the model Figure's developing. It's the application of a data set around folding laundry. And, Austin, the key long-term concept is what we're seeing in robotics is exactly what happened self-driving cars. That's allowing that industry to see furious scale, because in the 2010s, the architecture of AI models back in the deep learning age, they just weren't powerful enough. I went and visited Google, and they would have these tracks where they would almost have to code in specific instances. It just wasn't going to be scale enough for the endless amount of edge cases. And this decade, it's better architecture that allows for just full neural net driving, which is what Tesla's gone to. We're seeing this play out in robotics. And you see something like this laundry demonstration that's enabled by data. And I'm just convinced we're going to see a replay of what's happening in self-driving cars where they're very real. They're coming to a city near you. And this is going to happen in robotics. We're going to begin seeing an S-curve. And once we begin seeing an S-curve, it's enabled by this virtuous cycle where this progress that we're seeing enables more investment in the industry, which brings down the cost of those kind of things like actuators that make robots so much more expensive. And again, the more we have, the more we see this price collapse that brings it into the range that you would be interested in buying one to fold your laundry, because you're probably not interested at $30,000. But maybe at $5,000 to $10,000, you're pretty interested in this. So I think we're on the precipice of that.
And you and I have also talked about this, but these are kind of the hardest moments to envision in our world because they rely on a convergence of technologies and affordability landing at once. But once they do, an entire new industry emerges and then costs become affordable. So if you think about what needs to happen in robotics, whether it's humanoid or special purpose. You need a convergence of a lot of things. You need better actuator technology, you need better battery technology, you need the artificial intelligence, you need, and in some cases, if it's remote in the world, you need 5G and better data transfer. But once those things happen, these things that were never possible before are suddenly possible, and you can see these robots that are $5 or $10 or $20,000 solving $100,000 problems, which makes them so valuable relatively. The value proposition is so high, which then further drives down costs because they're now able to get all this new capital and make further advancements. I did find that thread, by the way, if anybody's interested. This was by Jack Lewis P on X, and the actuators I was thinking of are IM Systems NL. And if it at
let's put in the show notes.
We'll put in the show notes as well. If somebody out there is an engineer and actually understands these, I would love for them to let us know, or let me know, if this is actually impressive or if I just got pulled into a cool Twitter thread and it's not actually meaningful, because I think this thread is really cool. Okay, Eric, we buried the lead a little bit. Maybe we'll put in the title so people stayed with us this long. I want to talk about some portfolio buys. That's why people are here. They don't want, the news is probably fun, but they want to see you put capital to work in the AI portfolio. You've completed the Amazon sell. You've got about $44,000 remaining. What's going on? What are you doing? I think $44,000 remaining in Amazon, I believe, right?
Yep.
Which means you have $50,000 in cash to deploy.
Yep.
Wanted to clarify. Yep. What are you doing?
Yeah, as I mentioned earlier, I was close to some software options, but with the extreme volatility, how that market's being re-rated, I just wanted to take some more time, making sure I was getting stocks that are kind of going to succeed in the current environment. So, we'll have more buys coming. We'll probably do 5 to 10 buys at a minimum. I would guess in the coming quarter, probably more. We'll probably continue selling to get more ability to buy. But I've got 2 stocks today. The highlight is they're extremely speculative, which maybe, it's not the right time to be doing, as we talked about at the beginning with the market. But I'll talk about why these opportunities, I think, are specific to right now, that maybe if you wait on them for too long, you're going to miss out on some catalysts that are important. So let's start with optics, Austin. It's a space we've recommended a variety of stocks in. I'm not going to rehash the industry. We do have a complete episode if anyone wants to go back or you're new to the show. March 28th, we brought an expert on to talk about optics, but the short of what they are is they're all about the transmission of data. AI has grown data exponentially, as we've all talked about many times in the show. This is a massive boom for optics. They're more expensive, but they enable kind of data to travel over longer distances and have a number of other advantages. So we've recommended...
I'm not technically informed on data center building here, but don't they also allow greater utilization of your chips? Because when you have in sync data transfer and training, you don't sort of waste that run, because if you have chips that are not in sync, you can sort of waste a whole cycle of training.
Yeah, we could go in. One of the problems is if you're working on coherency, there's just a lot of limits to copper and distance. And while it's more effective, it's going to limit, as you're saying, if you want to connect a lot of clusters together, you're not going to be able to do that. You're going to need to go to optics. So that's kind of where you get towards these large sets and a need for optics. But regardless, we've recommended 3 stocks. We've got Coherent, Fabrinet, I should say, and Lumentum. If you're buying one of these stocks, if you're new to this, the one that I've liked the best in the past is Fabrinet, in the sense it's more akin to being the Taiwan Semiconductor of optics. They work on designs, so they're going to be a little bit more resistant to some industry changes that could hurt some of these other companies more. Now, as I mentioned earlier, it should go without saying that this is an industry where every single time the projections for data center spend go up and up and up, it's good for optics. Even with the recent post-earnings hiccup for Coherent, it's up 81% since early April. Lumentum's up 130%. Fabrinet's up 91%. Yet, the smallest and most speculative of these domestic options plays, Applied Opptoelectronics, that's ticker AAOI, is down 37% year to date. So they've been lagging, and a lot of that lagging's come kind of in recent months. Now, they're projected to see sales growth of 67% next year. That might prove conservative. And a big reason why is Amazon, they took grants in the company and they're highly incentivized to buy their products. Microsoft has a deal with them as well. So between those two, you've already got access to about 50% of hyperscale spending. And what Applied Opptoelectronics is aiming for is an 8.5x boost in demand for products that are about to go on a huge acceleration curve, which is 800G and 1.6T. And again, that's just basically talking about speed, bandwidth. So they also have a domestic supply story. And Austin, if you've been watching the news, you know how important that can be. So we talked about Marvell last week. This is kind of a similar story where the market is just betting that this company is not going to execute. That's not unfounded. This is a company that is smaller. They don't have the same engineering talent as their rivals, but their upside is substantial. So Austin, the stock, they're trading down 25% since June 20th. Fabrinet's up 25%. We like the risk reward of this situation. What we're going to do is we're going to add $5,000. This is a stock. You need to go into it with eyes wide open. There is downside of 50% or more, but we do see significant upside if this company is able to deliver on this significant acceleration ramp that the market is currently not giving them much in the way of credit for. So that's our first buy. I'll stop here if you have any questions. Otherwise, we can move on to the second buy.
No, just to reiterate what you said again and again, a word of caution. These next two positions are going to be some of the most speculative and volatile in the portfolio, high upside potential, but size your position accordingly. We ultimately you run a portfolio for the reason that no one position, right, should dictate your financial outcomes. So size your positions here accordingly.
Okay, great. And the second stock we're talking about, which is the smallest stock we've not only bought, but likely talked about on this show by far, is Tecogen. And last week, we discussed more on kind of a power bottleneck situation that's emerging as going to be, for the protracted future, one of the biggest stories in the AI space. We know that a lot more compute has to come online, but we have a situation in the US where we haven't really added much to energy since the mid-1970s. And that's going to require utilities investing in a way that they haven't before. It's going to require new approvals, and it's going to require new parts of the value chain. So when we explored this trend initially on the podcast last fall, we had recommended Vertiv and Schneider Electric. I continue to think both those stocks, they're good additions today. They both offer services that are just seeing wild demands gain, which is kind of this expertise in building data center components beyond just the chips. We're talking power generation, the backup systems, cooling products. Specifically, cooling is very interesting because we've talked about this ongoing growth of Blackwell. And Austin, not just Blackwell, but every subsequent chip behind it, the cooling needs are growing by substantial margins. So we have cooling going from something that's effectively a very niche part of data center spending to one of the core contributors of data center spending. And it's all beginning to happen right now. So it caught my eye when Vertiv signed a deal with a very small company named Tecogen back in March to offer chillers. And what chillers do is they allow a company to shift cooling load off the grid and onto a gas engine. Basically, when the grid is tight, this is one way to save on power. It's extremely attractive for the very unique situation we find ourselves in today. And the stat Tecogen is used is that cooling for Blackwell chips, which again is just beginning to happen, can be 25 to 35% of a data center's total power. So while Vertiv handles the actual liquid cooling inside a data center, the heat that's dissipated goes towards one of these chillers. Now, Vertiv, they're a huge company. They've got plenty of agreements. So one area I was watching for this week was Tecogen reported earnings. And I wanted to see if there's actual progress because it's a great story. But is there actual momentum happening? And what they say is they've signed an agreement with a 100 megawatt data center for chillers that starts late in the year. And they've also been asked to provide quotes for two projects that are 60 to 100 chillers each. These deals could still not happen, but there's a very good chance that if they do go through, they provide a massive revenue acceleration in 2026. So Austin, people saw this news on their earnings call, and it was up 30% after. And where did it close the next day? Closed down 2%. And as we record this, it's down 4 to 5%. So that got me interested. I had been exploring the stock, wondering if it was something that, even though it was this small and speculative, if it was something we wanted to add. And after I saw that kind of momentum and the price reaction where a lot of people kind of sold the news, so to say, I said, let's start a starter position in this stock. So it's a $250 million market cap. This is several fold smaller than anything we've discussed, let alone bought. We're going to just limit to 2,500, I should say, to start. And I want to do that partially to really signal to people this is something I don't want anyone getting ahead of their skis on, because it has huge potential. I've talked about the market fit here is great. It's not without competition, but again, they've got the deal with Vertiv, the ability to offload power, the growth in liquid cooling, all is a really powerful accelerant that almost has nothing in the back and everything ahead of it. So I like this story. What I want to do, Austin, I want to do two things. We're going to make this purchase. I also want to do a little bit more of a kind of deeper dive into the company, because I don't want to take up, how far are we? We're at 50 minutes. I don't want to take up half a podcast talking about a company that half the people might say it's too risky for me past. Right. So I'm going to post this on our YouTube channel. If anyone's listening and they say, this sounds really interesting, I want more, you got to go and subscribe to our YouTube channel. We're putting great stuff there. We had videos on any number of stocks this week across that channel, but we'll offer that for a deeper dive. And also, I don't want to promise anything, but we might have some areas in development where we're going to be able to kind of follow this story a little bit more and look for kind of these emerging data center investments in some areas beyond the chips that goes beyond Tecogen. So Austin, I think, that's it. It's two stocks, small, speculative, but also pretty interesting. And hopefully, people listening, this is something I can't imagine many people have ever heard of these stocks watching the show today.
No, I love this. And, those ticker symbols are Tecogen is TGEN, Applied Optoelectronics is AAOI. I know we're at time here, but I actually do have a quick question for you on Tecogen, just because it is so small and interesting. This company's up 160% in the last year, so there's already some excitement about it, but it's perfectly positioned to help chill this wave of Blackwell chips that are coming down the pike. So we've great narrative. They've gone from trading from about 5x revenue to about 10x revenue. So it's a $250 million company, still small, but they do 25 to 30 million a year in revenue on average. So when I hear that, this feels to me like this is a company that could be an acquisition. Now, you should never make an investment with this in mind, but I'm just wondering, that feels like a potential outcome for a company this size, because if you're only quote, a $250 million company and you've got great technology, I could see one of the hyperscalers saying, yeah, like this is worth $400 million to us because of these data centers we're building, and we can remove a key technology from the landscape and hurt our competitors who are trying to outrace us here. So this feels like a relatively easy acquisition. I'm not saying that that's why it's in the portfolio, but that's just where my mind goes. What do you think about that?
Yeah, it's an interesting question. The other companies like a Vertiv or a Schneider type companies, they could be looking to fold in some new assets around chillers as part of their portfolio. So I could see the company, it hasn't been public that long. They need to raise capital for some of these plans, and they're shifting from being a services company to a products company. Like you said, it's tough to value on any kind of trailing ratio, because what it was and what they're aiming to be are so vastly different of outcomes. So it's risky, but it's fascinating to find these places that, we just have this exponential rise in largely ignored areas before. And you look at a stock chart and it look like you might have missed it. I don't believe that's the case. I actually think there's something very exciting above, and whether or not they capture it, someone will. So I think it's exciting.
The past is not the thesis here. It's all about the future, and companies reinvent themselves all the time. We've seen it with NVIDIA. They went from video games to self-driving to AI. We've seen it with Oracle many times reinventing themselves. But Eric, I really do want to keep us under the 1 hour mark here. So I'm going to sprint to the finish, not to cut you off, but I do want to try and get us in under an hour. So just looking ahead to a preview of our next episode, right? We're closing in on the 1 year anniversary of the podcast. Congratulations to you and any of our listeners who stuck around that long. We're going to do a little bit of discussion about what went right and what went wrong. And I know you're going to be doing some more portfolio buys. And then Eric, last words from you. You've been talking about some of the things that you'd like to add to the podcast and some sort of coming soon teasers. So what did you want to share with our listeners?
Yeah, I think we continue to make some significant investments in expanding the podcast and making it more interesting for users. So as I mentioned, we're doing more content on YouTube that includes segments from the podcast, but also areas that expand upon the podcast and offer more investing ideas. One area that I've been pursuing across this week is speaking with some experts across areas that should be very interesting for anyone interested in AI. I've got an expert in the space industry that we're working on a time to talk. I've got someone in deeply embedded in the video game industries that we're working on time to talk. I've got one of the most knowledgeable investors across the technology space I've ever met that we are also setting something up with him. So, things might get canceled, but I expect people to see several of those. And we've also reached out to some of the companies that we discuss on the podcast. I'm not going to name individual names, but we might have an opportunity to go a little deeper and kind of give people some kind of behind the scenes into the industry looks at what's going on in this data center boom and this growth of AI. So I think all those things are really exciting. We're excited to enter a second year with everyone. And again, we thank everyone. And we ask, if you are enjoying it and you want continued investment into this podcast, number one, give us a review. We'll always ask for that. And the second thing would be subscribe to our YouTube channel and, ask some questions, because we'd love to make this a community and very collaborative. So you can leave questions in YouTube. If you freshly subscribed, you can send to the email address we've mentioned before, which is questions@247 Wall Street. Or you can leave a question in a place like Spotify itself. So you can follow any of those paths, and we would love to continue making this not just a show about AI, but a community of people who are really wanting to make the most of what we believe will be the biggest trend in the history of investing.
Eric, with that, thank you so much. Listeners, thank you for tuning in. We'll see you all in about 2 weeks. Take care.
The AI Investor Podcast is for educational purposes only and should not be considered investment advice.